Good morning, everyone. This is Windsor Brokers live daily market outlook for Thursday, 12th of July 2012. Top releases during the night were, of course, Bank of Japan's policy announcement and the Australia's job data that came on unexpected weak levels that pushed the Australian dollar significantly lower after initial pace regained, and looking for test of the upper sides and a possible break above 200 days moving average. More of this we will see on our technical part. For now, just saying that one of the top performers along with the dollar yen is Aussie dollar during the Asian session, as it suffered significant losses after the jobs data, as well as pardon, dollar yen raising nearly full rally of yesterday's strong bounce of 79.12 that again approached 80.00 but failed to break higher, proving that quite strong barrier lies at 80.00 point, as heavy selling pressure appears at that zone. As said, the Bank of Japan held off on further policy easing on today's meeting, despite slowing global growth that has driven other major central banks into expanding stimulus, convinced that robust domestic demand will keep Japan's economic recovery on track. As immediate reaction, the yen briefly fell and government bond futures rose after the central bank reshuffled the composition of its 70 trillion yen stimulus program to buy more short-term securities and reduce the amount offered in the fixed rate market operations. But initial market reaction soon faded as the yen bounced back, as the move was mainly a technical adjustment by the central bank, which is desperately trying to force feed the money to markets already awash with the excess cash. Also important to mention yesterday's FOMC minutes, saying that basically comment that U.S. Federal Reserve is open to buying more treasury bonds to stimulate the economy, but the recovery might need to weaken for a consensus to build, as minutes from the central bank's June meeting released yesterday showed. The Fed's last month expanded its latest effort to keep long-term interest rates low, announcing it would buy an additional 267 billion US dollars in long-term bonds with proceeds from a short-term debt in a measure known as Operation Twist. Even given that modest step, many economists expect the U.S. Central Bank to ease monetary policy further by eventually launching a third round of outright bond purchases that would increase the size of its 2.9 trillion US dollars balance sheet. The minutes of the June 19th, 20th meeting showed a few officials on the policy setting Federal Open Market Committee thought recent softness in the economy was sufficient to justify bolder action, but the report suggested the majority of policy makers was not yet on board, at least not before last week's employment report, which showed disappointing 80,000 jobs that were created in the month of June. Negative sentiment still seen in the markets regarding the single currency and the sterling that extended its weakness at the early hours of European session, as well as commodities, especially gold, that remains under pressure, especially after yesterday's Fed's release and the comments seeing more potential towards the downside. As currently gold standing at 1567, close to our downside support at downside target at 1550, and a more significant 1530-20 support zone, while crude oil is in rather neutral mode in past couple of days, moving within the 83.65 and 86.45 range, but larger picture still maintains sort of a positive tone of double bottom at 77.27.54 zone. Again, more of this will be seen on our technical part. Just brief look at the calendar to see today's releases and the indicators to come. As said, the Australian unemployment rate came along with expectations at 5.2%, but unemployment change dropped significantly to minus 27,000 compared to plus 27,800 in the month of June, and just at 0.3 thousand forecast for today. Bank of Japan has said kept its rate decision, kept its rate at 0 to 0.1%. Another significant decline was seen in the Germany's wholesale price for June, that dropped by 1.1% compared to forecast and the previous release at minus 0.7%. Still to come, industrial production from Eurozone due at 9 o'clock GMT May release. No change expected in monthly release, while yearly one is expected to drop to minus 3.3% compared to minus 2.3% of the month of April. US weekly jobless claims are due at 12:30. A further increase to 379,000 compared to adjusted 374,000 of the previous week release. US import and export prices due at the same time, minus 1.7% forecast for import prices for June compared to minus 1% in May, while export prices are forecasted for a slight improvement. Minus 0.3% is the forecast compared to minus 0.4% of May's release. And the Canadian new housing price index for May is expected to stay unchanged at 0.2%. Federal budget balance from US for June is due at 1800 GMT, and the minus $75 billion is seen as today's consensus compared to minus 124.6 billion in May's release. And finally, we're going to take a look at major currencies and the commodities to see what are the expectations for today and the previous movements. As said, star performer was Aussie dollar, so we're going to start with this. It's a quite interesting situation as the pair found good support at 101.50 zone on its reversal from 103.26, basically part of the larger rally that was corrected, that underwent corrective action from 103.26, finding good support at 101.53, and subsequent fresh rally was basically looking for a clearance of 200 days moving average, currently at 102.71, in order to refocus 103 and 103.26. However, disappointing data that came overnight did not actually put additional pressure on the pair, as a brief break above 200 days moving average failed to materialize gains, and the subsequent weakness accelerated on the release of Australian data, coming very close to the previous low and higher base at 101.50. So 101.53 was low of 9th of July, currently 101.57. We have seen with extremely negative tone seen on the near-term studies, and yet no signal of reversal despite hourly studies being at their extreme downside points. 4-hour chart studies are just turning into the red territory and seeing more potential of further retracement of the initial 99.68 to 103.26 rally, with the level coming close to 50% retracement. That reinforces the current support at 101.50, a break of which definitely to open way for a further reversal, and focus 101.25 and 101.05, that marks 61.8% retracement, with the break below this level, possibly to look for test of the parity and another higher base at 99.68. But overall picture is still, on the larger picture, pardon, is still holding a positive tone despite recent upside rejection, but a threat is seen as the pair breaks below the ascending trend line of 95.79 low 1st of June with the further extension lower and break below 101 and 100 2030 zone, where it's 50% retracement as well as 55 days moving average to weaken further the structure, as the daily studies are slightly losing initial bullish momentum, and basically the threat will be seen on a loss of 101.50 and 101.00 with the break below 100 2030 and the parity level to definitely turn the focus towards the downside. On the upside, the immediate barrier is at 101.80, 102.00, ahead of a more significant 102.25, 102.50. Basically, break above these levels is required to improve the current structure and refocus levels at 103. First of all, a break of 102.70 to 100 days moving average, and then to refocus 103 and 103.26. So far, negative near-term tone dominates in the near-term outlook, and sees a real threat of retest and break below 101.50 higher base, as the losses accelerated after releasing Australian data, and the upside rejection under 200 days moving average keeps additional pressure on the pair. Also important, significant action was on dollar yen, as basically the pair remains within the 79.80 and the 79.00 and 80.00 range, as the upside remains well limited at 80.00. For proof of this is the yesterday's sharp rally that initially hit 79.78 and then followed by a brief pullback with the release of Bank of Japan's data, triggering a knee-jerk reaction that basically hit levels close to 80.00. 79.94 was seen as a spike higher, with subsequent immediate reversal lower, showing that 80.00 proves to be quite a strong barrier, and a strong downside pressure still exists, as the pair breaks below the midpoints of the range and comes to the lower levels. Immediate risk is seen towards the downside. Hourly studies are pointing lower and approaching their center lines, a break of which, of course, to refocus yesterday's low in 79.00 and then more significant, 79.12, and the more significant 79.00 range floor, where is also the 200 days moving average break of below the past 3 weeks ranges to define the fresh direction towards the downside of dollar yen, as daily studies are still in rather negative. There was no clear break higher at this point, as the upside remains well limited by 80.00 and 80.60. More likely reaction will be a break on the downside that so far remains also well protected at 79.00, loss of which to trigger a weakness towards 78.60, 78.00, and a possible extension down towards 77.65, 1st of June low. Not much shown on the euro-dollars past 24 hours price action, just to say that the pair remains in the downtrend and continues to trend lower, posting the fresh lows on a daily basis, with the latest one hit at 122.11 at the late hours of yesterday's American session, with brief consolidation being capped at 122.44. That's the high of the overnight session, and tightly limited by 200 days descending 20 days exponential moving average on the hourly chart. The other dynamic barrier, 55 days moving average, that limits the upside from its break lower from its where the price broke below this indicator on the 5th of July 2012, maintaining also the negative structure currently standing at 122.63. Focus remains firmly at the downside as at the beginning of European session the pair again loses ground and approaches overnight lows that will open immediate support at 122.00 ahead of 121.50, our initial target, June 2010 lows, with the increased risk seen on revisiting 120.00 as a round figure and a strong psychological support, as shown on the weekly chart, as the pair remains in the strong downtrend in the past 1 year and 2 months from 149.38 peak of 2011 posted on the 1st of May, with the near-term focus at 121.50 as said, and 120.00. Any corrective action that is seen not likely at this point will face dynamic barriers at 122.43 and 122.63. However, break above 123.00 and more significant 123.33, a peak of 10th of July, is required to ease the current bear pressure and avert immediate risk of further slide. Any bounce, any reversal under these levels would be just seen as corrective and preceding a fresh weakness. And also quite interesting situation on sterling dollar as it lost traction on yesterday's upside rejection at 155.76, with subsequent strong fall initially through 155 and 154.95 trend line support, dipping initially to 154.85 as the brief corrective action was capped just above 155 and limited by descending 20 days moving average. The barrier is reinforced by crossover of 20 below 55 exponential moving average, triggering fresh weakness that accelerated at the beginning of European session, losing its initial supports at 154.77 and 154.60. Actually, 154.60 is seen as a quite strong support, and it's a base of past 1 month that held the downside protected. Now the immediate focus comes at 154.00 and more significant 153. 153.00, the long-term base that holds the downside protected from September 2010. As well as just before this, we have at 153.50 the long-term bull trend line of 2009 low at 135.01. Break of these very significant supports, 154.00, 153. What did we say? 153.35 and 153.00 would be trigger for a further and more significant weakness of the sterling against the US dollar. Near-term structure remains firmly bearish, with the studies in the overextended at their extreme downside points, yet no any signal of reversal. And finally, we're going to take a look at commodities. As said, crude oil remains entrenched between 86.46 and 83.64 range, with rather neutral tone seen on the 1-hour chart. 4-hour chart studies, however, still keep sort of positive tone despite a recent upside rejection at 88.97, subsequent pullback that so far retraced between 38.2 and 50% of initial rally from 77.27 to 88.97, as temporary ground was found at 83.64. Potential of further gains are not ruled out, but clearance of a range top at 86.46 that showed a double failure on 9th and the 11th of July still keeps risk on the downside. Current range, a break of the range at either side is to define the near-term direction of the crude oil. A larger picture is more the daily chart of crude oil shows some improvement in the situation, but still a regain of 88.97 and 90.00 is required to sustain the current rally and of double bottom at 77.54.27 and spark stronger recovery, as current recovery was limited by approximately levels approximately close to 38.2% retracement of the larger down move from 106.41 to 77.27. And a quick look at gold that again came under heavy pressure after brief recovery attempt of 1564, failed under 1600, being capped by descending 55 days moving average as shown on the hourly chart, and the acceleration of reversal from 1583 now tests initial support at 1564, break of which to signal continuation of the down move from 1624, 3rd of July peak, and open 1550 as the next target ahead of a more significant 1530 and 1520, the critical support zone, as the larger picture studies are quite weak at this point, and the yellow metal remains in the strong downtrend from last year's record peak at 1920. It seems that test of this critical support zone 1530, 1500 would be the likely scenario in the near term. Failure to break lower in case that losses will be again contained might be signal again for a further ranging as the pair remains, as the gold price action remains now congested within 1530 and 1640 band, and basically break above 1640 is required to improve the current structure and avert immediate downside risk. Thank you for attending our live sessions. That was all for today. We're back tomorrow morning at the same time at 7:00. Our questions and answers session will follow shortly. Stay tuned, and we will be back. We're looking forward to see you again tomorrow. Good luck.